So a lot of people are wondering what's going to happen next year as the Fed is raising rate. Currently the 2-year, the projection is around 4.6, which is the target Fed fund in December 2023. Right now it is around 4, or the year end is going to be 4. Right now is around 3.5-ish. So there is another 2 points to go before 200 basis points to go, where the Fed fund would be in 2 years. So that means we have never seen actually this kind of raise, in most of our adult lifetime. So let's say 2008, around the time before the financial crisis hit, everywhere globally, the rate, the 10-year, 2-year rate was about 4.5. The 10-year and 2-year was well below 2%. So there is a spread of 2% between 2 and 10 before the financial crisis, actually the global financial crisis, or GFC, happened. So now, before that, around 2001, or rather even before, in 1990s, the 10-year, which kind of is your proxy for the growth, economic growth for the country, was constantly around 4% or above. Whereas the 2-year, which is your current Fed rate, which was less than 3%, so around like 2.5 to 3%, which was basically the interest rate you'd get when you were in the when you're putting your money in the savings account. Now the question becomes that when you have this alternative investment option, then how stock market will behave. That's number one. Number two is that as the capital cost of capital is high, then how the growth companies will work. Because previously what could have happened, as the 10-year and the 2-year was cheaper, so during this pandemic, actually you'd be there's a negative interest, so you have actually essentially free money. If you're an investor, you could easily short the 10-year or 3-year or 2-year US Treasury, collect whatever money you want to collect by selling those, by shorting those positions, so shorting those bonds. Let's say you are $1,000 of a note, and you're shorting hundreds of them, so you collected $100,000 cash. Now obviously you have to pay back in normal some circumstances to the interest payment to the treasury, because you're shorting it, so you have to pay out the interest, and that would be generally in the low interest environment would be maybe 1% or 2%. But in the pandemic, or 2019 to 2022, early 2023 timeline, it would be near 0%, because the Fed was doing the QE, which is basically Fed was buying bonds that would keep the bond price low, and basically money was free. So you can short and collect this money, then you could use your leverage account, and you could basically buy a dividend yield or ETF or whatever, and then you collect the money, you pay back the loan, or you don't, if you have a low interest, and basically it's a free money. Whatever even if you're losing some money, even if you're making 1% interest rate, 1% gain, then it's still 1% free gain, because you don't owe anything to anyone. Compared to that, if you actually let's say you borrow money from the bank, you still have to pay whatever interest rate you're paying. And selling shorts treasury, if your account allows it, was much easier. Now imagine if you're a company and you want to do the same strategy. You want to get, if you're a bank, let's say, and you're shorting the treasury, and you have this capital, you can give this money, this capital, allocate that to whoever is asking for you to loan, and you can actually get charge them a 3% or 2%, and that 2% is your pure return, right? So the banks would make money because of the 0% interest, or whatever they are actually able to make now by financing these loans, right? And then because of the they can short and get the money at 0%, Not anymore. Now that we have this scenario where money is no longer free, you have a 3% to 4% of the 2 year. So that means that if you short, then the bank has to pay this 3% back, which is not easy, which is actually is quite a bit of amount if you think about it, right? Like, they were used to getting the 0%, now they have to pay 2%, 3%. Now something has to give. That means that the bank, if they give out the loan, then previously they're getting this 2%, 3% return. Now, in order to get the same 2%, 3% return, you basically have to give that loan, pay or give out the loan at a much higher rate. So that means that if I'm a company, I'm looking for capital and I'm going to a bank like Chase or anyone else, then I have to really, pay or, get a loan. In last year, it was maybe 2% have to give interest, incur interest of 2%, 3%. Now I have to give 5% because bank themselves cannot borrow the money without paying the government 3% interest, right? So that's the thing. So that means that the question becomes that which companies are okay to make 5%, to pay that 5% interest loan, or which companies are not. That means you must have at least 5% or above, just simple math. It's a little bit complicated than that, but let's say you have to actually have your operating profit before the EBITDA, before the tax and other stuffs, it should at least have around 5% margin, right? So your margin must be 5%. Then you are paying the employees, you're paying your suppliers, and then you're just keeping something for yourself for the investment, and then you pay 5% to the bank, and then you're breaking even. Otherwise, what happens if you're really making 4 or 5% and you're paying interest at 5% or more, then really your balance sheet is shooting up. So it's difficult for all the business to make money in this environment, and that is why they're saying that the good quality companies would do well. Good company means that the companies which actually has a pricing power, means they can increase the price to the consumer. They have at whatever rate they want, and they have a good balance sheet. That means that even if actually in the next 1 year the interest rate goes up even further, so the cost of borrowing money is even higher, then basically that means that they can sustain. And third is that in case the best option is that if they don't have to actually get much loan, but that never happens. All companies want to get loan because they want to actually be a better tax benefit. It's better to get a loan, just like your house. You don't want to pay off even if you can afford, you don't want to pay off the house because your interest rate is tax deductible. Same way, the companies would like to get loans because that's actually tax beneficial for them. So overall, all in all, I think this is why it is important that in the next few months or so, we'll have to see that a lot of these companies were in the debt. They had free money. They had they were projecting that they will be EBITDA positive by next year, and that equation now changes. So now the question becomes that do you want to invest in these companies because your EPS, for example, was projected based on the free money they got and the expansion they had, the growth rate they had. In that equation, the free money generated EBITDA would have been positive next year. So Uber and other companies were supposed to go, they're already positive cash flow, but they're supposed to expand in a much higher rate next year. Now the valuation of these companies will go down. So that means that you really have to be picky that which companies really make sense to buy stock, because your multiple, as your EPS goes down, even if you keep the same multiple, your stock actually is supposed to go down. If you increase the multiple, which might happen because people are the best case scenario is that your stock price does not grow. Either it's the EPS, if this remains, the companies which will have the higher EPS, they will really be the winner. So here it's very important to see that which companies which actually had a good, okay balance sheet, not a great balance sheet. I mean, Apple and others were the great balance sheet, they're supposed to have a better EPS, that's for given. But the companies who had For example, Uber is a good example. Uber, if they can show that the EPS is much better than before and that growth is also better, that means they are going to meet the expected EBITDA next year. That means the current valuation is right, and people, because the demand of that stock will be high, so everybody is looking for those kind of companies, everybody will pile on, so the stock prices go up, so the multiple will also go up, even if the EBITDA is the projected EBITDA is same or even slightly better. So that's kind of the stuff that we'll be looking for in the next few months or so, and then that's the stock pickers environment right now.